because gold is moving to all-time highs, meaning the dollar is moving to all-time lows, it means that the next round of inflation is already here.
You're watching Silver News Daily. Subscribe for more. Imagine waking up one morning in May 2024 to find that silver, often considered the underdog of precious metals, has shattered all expectations and skyrocketed to $1,000 per ounce. Yes, you heard that right, $1,000. This incredible prediction comes from none other than renowned financial analyst Rafi Farber, who has a track record of bold and accurate forecasts. How could this possibly happen? Stick around, because we're diving deep into the factors that could make this unprecedented surge a reality.
Where we are right now, well, if we treat gold as not a currency, it's money, but if we as a currency, as you would look at, let's say, the dollar or Japanese yen contract, then the dollar is getting weaker in terms of real money. And usually when that happens, price inflation, as the Keynesians describe it, is not far off in terms of accelerating. We also see that I configured a chart showing how copper prices are very predictive of CPI numbers. It's the CPI numbers. I don't think they're honest or anything. It's not that I ascribe any power to them, but they do affect psychology, and I think they will be a factor in letting people loose and changing their mentality from, it's the economy strengthening to, it's the dollar falling. Because really all inflation is really the dollar falling, and the economic growth through inflation is all an illusion. It's hard to tell when it's slow because they can mask it. So I think because gold is moving to all-time highs, meaning the dollar is moving to all-time lows, it means that the next round of inflation is already here. And you can even see it in the CPI numbers now, but it's about to get a lot worse. And then the question is, what's the Fed going to do when it gets worse? And the only thing they can do is raise rates. But people are still in the false Keynesian conception that raising rates lowers inflation, what people call inflation. But that's only true when your currency is not 93% backed by debt that depends on interest rates. So all central banks are in the same problem now. If they raise rates, prices go higher. If they cut rates, prices go higher. So in that sense, I think we're in an unavoidable beeline to the end game. Doesn't mean there won't be wiggles. There will be, but the trend will be more obvious as the weeks and months ahead. And you can see that in the progression of articles that have come out over the last few months. Some starting with, there's going to be 4 rate cuts this year, and then 3, and then 2, and now 1. And now I just saw the first article that maybe there won't be any, and maybe we're in a Volcker-like situation. And don't worry, even if we raise interest rates high enough, everything will be fine eventually. And if inflation will be conquered, just like Volcker did, except Volcker didn't have to deal with $35 trillion of debt at 20% rates. It would bankrupt everything, and it would destroy the value of the dollar because, again, the dollar is backed by 93% debt, which plummets in value when you hike interest rates. So there's no way out of it now. We're headed there. It could take months, but the trajectory is really coming into focus now.
To understand how silver could reach the astounding price of $1,000 per ounce, we need to look back at its historical performance. Silver made headlines in 2020 when it surged above $20 per ounce for the first time in 4 years. It climbed even higher, nearing $30, but has struggled to break past that point since then. The highest recorded price for silver was just under $50, achieved in the 1970s and again in 2011, driven by strong investment demand. These historical highs set the stage for understanding why current market conditions could propel silver to new unprecedented levels.
Yeah, people make a big deal out of what path exactly the powers that be are going to take, or the government's going to take. Are they going to do bail-ins? Are they going to do bailouts? The truth is, it doesn't matter, because either way, it ends up the same thing. Your dollar will be worthless. If they do bail-ins, it's technically more honest, right? If they just take your money and then purge it out of the system, or they could print more money and try to reinflate the system. Either way, you end up with nothing. So don't worry about the method by which they're going to do it. it's all theft in the end, right? There's three ways for government to raise money. There's direct taxation, which is theft, and you could argue that a certain amount of theft is necessary, or if you're a minarchist, you could say that. And the other thing they could do is borrow, and since they borrow generally for war or stupid regulations that cripple production rather than help it, then that money is going to be paid out of more taxes. Or the third way is inflation, but it's all stealing. So they're going to steal until you've got nothing. So take what you have and put it in a place where they can't find it. That's the safest way to go. And it includes if you have retirement accounts, IRAs, 401ks, whatever these numbers and letters are, they're going to take it all, either through the value of the dollar or just through confiscation. Well, we saw that Biden wants to put a 44% capital gains tax now. So what they could do is an IRA, well, a special government emergency, anyone who holds gold in an IRA. I'm not saying they're going to do this, but it's possible. Anyone who holds gold or silver in an IRA, there's a special windfall tax of 90%, and it goes to the government. No one's going to stop them. So I can see that happening too. So you really got to hide it. What else can I say?
Currently, silver is quietly making significant strides in the market. After hovering in the high $20s, silver recently surpassed the $30 mark, reaching an 11-year peak. This momentum is fueled by several factors. For one, heightened expectations of interest rate cuts are driving investors toward precious metals as a safe haven. Additionally, geopolitical tensions, like the Russia-Ukraine conflict and ongoing instability in the Middle East, are increasing the demand for secure assets. On the supply side, there's a notable deficit in the silver market. Mining production is struggling to keep pace with growing industrial demand, particularly from the renewable energy sector, which relies heavily on silver for solar panels and electric vehicles. Analysts like Keith Neumeyer, CEO of the First Majestic Silver, point out that the supply-demand imbalance could push prices higher. Neumeyer himself has predicted triple-digit silver prices, citing the metal's essential role in emerging technologies and its undervaluation compared to gold. Adding to the bullish sentiment is the performance of gold, which often influences silver prices. Gold has seen a resurgence, threatening its all-time high and drawing attention to its sister metal. With central banks buying up gold and inflation fears rising, silver stands to benefit from the spillover effect. As these dynamics unfold, the stage is set for a potentially explosive rise in silver prices, validating bold predictions like Rafi Farber's forecast of $1,000 per ounce by May 2024.
Seeing gold move higher, and we're seeing gold move higher because there's going to be no rate cuts. It would move higher it would move higher if there were going to be rate cuts, but that's what's so hard to really internalize, that whether you hike rates or don't hike or cut rates, it's going to go higher. But you see, like on every piece of news that inflation's higher, or that there's going to be fewer rate hikes, gold goes up. That just proves that we're already in the late 1970s scenario here, which is exactly what happened back then, right? The interest rates that Volcker kept hiking didn't bring gold down and didn't bring prices down until I only learned this recently, but he had to hike rates to 20% 3 times from 1980 to 1982, and eventually gold calmed down. But what Volcker didn't really understand is once you get gold to calm down, then eventually prices will start to fall. Just as gold leads prices higher, when it falls, it does prophecy. You could say that eventually consumer prices are going to go lower, because consumer prices are the last to be affected in any economic system, because they're the farthest away from the commodity space, which is the initial production stage. And by the time prices affect consumer goods, it could be months to years out.
Rafi Farber's prediction of silver reaching $1,000 per ounce by May 2024 is bold, but it's based on a detailed understanding of market dynamics and economic conditions. Farber, known for his insightful analysis, sees several key factors converging that could lead to this dramatic surge. Firstly, Farber points to the cyclical nature of the market. He believes we are in a phase similar to the early 2000s when commodities were undervalued, and a significant rebound was imminent. He draws parallels to that period, suggesting that the current economic instability, characterized by inflation and geopolitical tensions, sets the stage for a precious metals boom. One of the core aspects of Farber's prediction is the significant undervaluation of silver. He argues that the silver market is being manipulated by large institutions through extensive short selling in the paper market. This artificial suppression, according to Farber, has kept silver prices lower than they should be. Once these constraints are lifted, he believes the true value of silver will emerge, leading to an explosive price increase. Additionally, Farber highlights the growing industrial demand for silver. The metal is crucial in numerous technologies, including solar panels, electric vehicles, and electronics. This industrial demand is expected to rise significantly, particularly with the global push towards renewable energy. At the same time, mining output has not kept pace, leading to a supply deficit that could drive prices higher. Farber also points out the potential for a significant catalyst to trigger a rush into silver. He speculates that a major investment by a high-profile figure, such as Elon Musk, could draw massive attention to silver. Musk's involvement would not only highlight silver's importance in technology, but also stimulate investment interest, further propelling prices. Moreover, Farber emphasizes the current favorable economic indicators. With inflation fears rising and central banks buying up gold, silver is positioned to benefit from the increased attention to precious metals. As gold prices surge, silver often follows due to its historical correlation and the gold-to-silver ratio. All these factors combined create a scenario where Farber's $1,000 prediction, while audacious, is not without basis. It's a confluence of market cycles, supply-demand imbalances, potential market catalysts, and economic conditions that make this prediction plausible. As we approach May 2024, watching these dynamics unfold will be crucial to understanding if this unprecedented surge in silver prices can indeed become a reality.
That it wasn't actually me that noticed it. It was a subscriber. It was an in-game investor subscriber that sent me this article about UBS, which tells you something that they're not putting it in the headlines, and they're using different language, right? I think it said UBS has capital needs up to $15 billion, right? Capital needs, and they need to make it more robust. So that's just nice language for bailout, and it's going to happen. But the fact that they're specifically not putting it in the headlines, it's not surprising because the mainstream financial media is all bootlicking the powers that be, as we all know. And so if UBS needs a bailout, then other banks are going to need a bailout again, because in an inflationary system, that's what you always need. And what else are we going to do? So if we go back to rate hiking, right? What caused the regional banking crisis was the fact that the bonds that were on their balance sheet were falling in value and they needed a bailout. So the Fed took that crap onto its balance sheet and made the dollar even weaker and gave them dollars instead, gave them reserves instead. So if we're indeed in a Paul Volcker situation and we're only at, let's say, 4.6% now, and we hike to, let's say, 10%, 15%, like Volcker did, then how much trouble are the banks going to be then? They're going to be dead. It's not even going to be a question. I wonder what the words to the title to that article is going to be. Like, instead of dead, what are they going to say? In the afterlife, or bank afterlife, and there's a bunch of angels there and they look great, and we congratulate the bankers for making it to heaven, something like that. I don't know.
One of the key drivers behind silver's potential surge to $1,000 per ounce is the current imbalance in its supply and demand dynamics. On the supply side, mining output has struggled to meet the increasing demand. In 2022, global silver production was around 800 to 825 million ounces, while consumption ranged between 1.2 to 1.4 billion ounces. This deficit has been ongoing for 6 years and is expected to widen further in 2024. A significant portion of the demand comes from the industrial sector. Silver is indispensable in many high-tech applications, particularly in renewable energy technologies. Solar panels, which require substantial amounts of silver, are seeing unprecedented growth due to the global shift towards green energy. Similarly, the electric vehicle market, which heavily relies on silver for its electrical components, is expanding rapidly. These sectors, along with electronics and other technological advancements, are driving robust industrial demand for silver. On the investment side, silver is gaining attention as a safe haven asset, especially amid economic uncertainty and inflation fears. Investors are increasingly turning to silver as a store of value similar to gold. This investment demand is expected to grow as more people recognize silver's potential for significant appreciation. Moreover, the silver market faces a unique situation where the paper market and physical market are often at odds. Large financial institutions have been accused of manipulating silver prices through the paper market, keeping prices artificially low despite strong physical demand. If this manipulation is exposed or corrected, it could lead to a dramatic revaluation of silver's true market value. Additionally, silver's price is closely linked to that of gold. Historically, silver has traded in tandem with gold, and significant movements in gold prices often lead to corresponding shifts in silver. With gold currently nearing all-time highs and potentially breaking through, silver is likely to follow suit due to the gold-to-silver ratio. This ratio, which indicates how many ounces of silver are equivalent to 1 ounce of gold, has historically been around 1:15, but has been much higher in recent years. A reversion to historical norms could see silver prices rise dramatically. Keith Neumeyer, CEO of First Majestic Silver, and other industry experts argue that these factors create a perfect storm for silver. They believe that silver is not only undervalued but also on the cusp of a significant breakout. Neumeyer has frequently predicted triple-digit silver prices, emphasizing the metal's critical role in modern technology and its constrained supply. As we approach May 2024, the alignment of these supply and demand factors, coupled with potential market corrections and increased investment interest, sets the stage for a possible unprecedented surge in silver prices. Farber's prediction, while bold, is rooted in these compelling market dynamics that could indeed push silver to $1,000 per ounce.
That in the 1970s bull market, let's say 1971 to 1980, silver did pretty much nothing in gold terms, at least, from 1974 to 1979. Didn't do anything. It stayed in a trading range with gold at about 35 to 40 per ounce, 40 to 1 ratio. And then all of a sudden, in 1979, it just went all the way down to 15 very quickly. And since I come from the Austrian school, I always look for a human action element in these type of things. And I think the explanation is pretty simple. Like the silver is the public's money, and it doesn't have much to do with banks. Banks don't have much to do with silver. They have to do with gold. Which is why the gold price is really rising now, because it's the banks that are in trouble, and they're the ones that trade money and currencies. But when the public finally does wake up, what happens is they look at the gold price and like, I can't afford that. How am I going to eat? So before you have a rush into any good and service, what Mises calls the crack up boom, or the flight to real goods, you have the public, at least the wise public, going into silver first, and they'll just buy it and return it to the public, because again, the silver was the public's money, and it's going to return to be the public's money. It's never going to be the bank's money. It's too bulky. It's good for the public, which is why 1873 was really the first crime of the first real crime of the monetary system. The gold standard enabled inflation, because prior to 1873, we were on a bimetallic standard. Even that wasn't great. What we should be on is two monies, two derivatives of money. Right? You should have two separate currencies. One let's say is like a gold dollar, and the other is like a silver schmaler, whatever you want to call it. It doesn't matter. But if there's two separate derivatives for two separate monies, and then like dollars and cents, they would change every day depending on market forces, that would be the ideal system. It would have to be honest. So I do think that when the public does wake up and they realize that the dollar is collapsing, and they're trying to retain their savings, the wise people of the public will first go into silver with whatever they can afford. And then once that's gone, or once even silver is too expensive, then you start the real hyperinflationary process, where people take whatever dollars they have and they just buy whatever they can get. So right before we see a hyperinflationary crash, we're going to see silver go to 15 to 1. And then around 15 to 1, that should I know this is an extreme statement, but I don't see any other way out of it. Once we see 15-1, I think the dollar will either freeze at a gold ratio that backs the Fed's liabilities by 100%, or if there's no gold in Fort Knox, it'll die completely, and then we'll have to start over, which is scary, but also glorious in the fact that all the insanity that is built up will dissipate because nobody will have any need for it.
Geopolitical and economic factors play a crucial role in shaping the trajectory of silver prices. The ongoing global instability, marked by significant events such as the Russia-Ukraine conflict and heightened tensions in the Middle East, has driven investors towards safe haven assets like silver. These geopolitical issues often lead to market uncertainty, causing investors to seek out more stable and secure investments. The economic landscape is equally influential. Inflation, for instance, has been a persistent concern. As the value of fiat currencies declines, precious metals like silver become more attractive as stores of value. The potential for rising inflation in 2024, driven by factors such as continued monetary easing and high government spending, could further increase demand for silver. Interest rates set by the U.S. Federal Reserve are another critical factor. Historically, higher interest rates tend to suppress precious metal prices because they increase the opportunity cost of holding non-yielding assets like silver. However, in recent years, even with rising interest rates, silver prices have remained resilient. If the Fed were to shift towards lower rates to combat economic slowdowns, it could provide a significant boost to silver prices. Moreover, the Fed's monetary policy is closely watched by global markets. Any indications of easing or tightening can have immediate effects on silver. For instance, if the Fed signals a pause or reversal in its rate hikes, it could lead to a surge in silver prices as investors anticipate a weaker dollar and increased inflation. Economic data from major economies also influence silver prices. Weak economic indicators, such as lower than expected GDP growth, higher unemployment rates, or declining consumer confidence, can drive investors towards safe haven assets. Conversely, strong economic performance can reduce the demand for silver as a safe haven, but this is often offset by its industrial demand. The performance of gold is another indirect but significant factor. Silver often trades in correlation with gold, and movements in gold prices can lead to similar trends in silver. Gold has recently seen a resurgence, threatening to break its all-time highs. As gold climbs, it pulls silver along due to their historical price relationship. This correlation is driven by investor behavior. As gold prices rise, investors seek alternatives like silver, pushing its price higher. Additionally, global trade dynamics, particularly between major economies like the U.S. and China, impact silver prices. Trade tensions or tariffs can lead to economic slowdowns, driving demand for precious metals as safe havens. Furthermore, policies aimed at boosting industrial production, especially in green technologies, can increase silver's industrial demand. In summary, the interplay of geopolitical tensions, economic indicators, Federal Reserve policies, and the performance of gold creates a complex but favorable environment for silver. As these factors converge in 2024, they could collectively drive silver prices towards the unprecedented $1,000 per ounce mark, predicted by Rafi Farber.
And they control the whole system. They control retirement accounts. They control pensions are retirement accounts. They control everything. They control the insurance funds, everything they got. So what do they not have? Maybe they don't have your backyard. Or maybe they do. I don't know. They're not going to be able to take everything. It's not going to because once they really fall apart, that's one of the blessings of hyperinflation. It happens so fast that the government doesn't have time to regroup and say, okay, we're going to do this. They can't even get together and plan because they're too big and clunky. So things just break down. And then the hope is that you end up with somebody like Milei, and he's not perfect, and I know there's problems with him, but you got to commend him for what he's doing in Argentina. And I don't think it's going to succeed in the end, but at least it's a good direction, and so we hope that something like that happens in the West, in the United States. But I can't promise it will. So you just got to be safe and be around a good community.
The relationship between gold and silver is a significant factor in understanding silver's potential price surge. Historically, silver has often mirrored the price movements of gold, albeit with greater volatility. This relationship is quantified by the gold to silver ratio, which indicates how many ounces of silver are equivalent to 1 ounce of gold. Historically, this ratio has averaged around 1:15, meaning 1 ounce of gold was worth 15 ounces of silver. However, in recent years, this ratio has been much higher, sometimes exceeding 180. This discrepancy suggests that silver is significantly undervalued relative to gold. If the ratio were to revert to its historical norm, silver prices would need to increase dramatically. Currently, gold is nearing its all-time highs, driven by factors such as inflation fears, geopolitical instability, and strong investment demand. As gold prices surge, silver is likely to follow due to their close relationship. Investors often turn to silver when gold becomes too expensive, seeing it as a more affordable alternative with similar safe haven qualities. This shift in investment can lead to significant price increases for silver. Furthermore, many analysts believe that silver has unique advantages over gold. While both metals serve as stores of value, silver has substantial industrial uses that gold does not. This dual role of silver, both as a precious metal and an industrial commodity, provides additional support for its price. As industrial demand grows, particularly from sectors like renewable energy and electronics, silver's price is likely to benefit. Investment demand for silver is also on the rise. In times of economic uncertainty, investors seek to diversify their portfolios with safe haven assets. Silver, being more volatile than gold, often attracts speculative investors looking for higher returns. This increased investment demand can drive up prices, especially if large institutional investors enter the market. Keith Neumeyer, CEO of First Majestic Silver, is one of the prominent voices predicting higher silver prices. He has repeatedly emphasized the disconnect between silver's industrial demand and its current market price. Neumeyer believes that silver's price does not accurately reflect its importance in modern technology and its limited supply. He argues that once the market corrects this mispricing, silver could reach triple-digit prices. Moreover, any significant developments in the gold market can act as a catalyst for silver. For instance, if gold were to break its all-time high and sustain those levels, it would likely attract significant media and investor attention. This attention could spill over into the silver market, driving up prices as investors seek alternatives to gold. In summary, the historical relationship between gold and silver, coupled with silver's industrial demand and current market conditions, sets the stage for a potential surge in silver prices. As gold continues to climb, silver is poised to follow, potentially reaching unprecedented levels, like the $1,000 per ounce predicted by Rafi Farber. This alignment of factors makes the coming months critical for silver investors and could lead to a significant revaluation of silver's true market value.
Yeah, well, if you have a closed circle of production and barter, I don't mean barter one thing for another thing, I mean barter with gold and silver, which is monetary exchange. If you can build up networks, then you can have transactions that are not tracked by the government. You pay for your meat in silver, you pay for your garden supplies in silver or gold or whatever. The more people you have involved in this that are transacting in coins with one another, the harder it will be for the government to track them. So we're going to have to do this together. It's not about everybody building a bunker. That's not efficient, right? Insurance works by pooling risks. So what you want to do is pool your risks and get people together and say, I have skills and I'm willing to trade them for gold and silver. Let's build the network out and separate as much as we can. And this is especially important for healthcare, right? Because you don't know what the doctors are up to these days and who you can trust for your health. So you want to get out of that too. And it's not just the monetary system; it's every system. It's education, it's medicine, it's monetary. It all starts with the monetary system, right? Because the inflation infects everything. It makes people not necessarily stupider, but following where their bread is buttered by who prints the money. So if the government controls everything, the government controls everyone. Unless you want to be bold enough to speak out, in which case you can get censored and destroyed, or be small enough to stay under the radar, which is kind of my hope, until the end comes and I can peek out and breathe a deep sigh of relief and help whoever I can.
One of the most compelling arguments for a potential surge in silver prices to $1,000 per ounce is the identification of potential market catalysts. These catalysts are events or actions that can trigger significant changes in market dynamics and investor behavior, leading to dramatic price movements. Here are several key catalysts that could propel silver to unprecedented heights. Major investments by high-profile figures. One potential catalyst is a significant investment in silver by influential figures, such as Elon Musk or other prominent entrepreneurs. Given Musk's substantial influence in the tech and renewable energy sectors, his involvement in silver could attract massive investor interest. For instance, if Musk were to announce a strategic investment in silver due to its critical role in electric vehicles and solar technology, it would likely lead to a surge in demand and prices. Technological breakthroughs. Innovations that increase the industrial use of silver can also act as catalysts. Advances in renewable energy technologies, particularly in solar panels and electric vehicles, can drive up demand for silver. If new technologies emerge that require even more silver, it could significantly boost prices. For example, any breakthrough in solar energy efficiency that relies heavily on silver could lead to increased consumption and higher prices. Market correction and exposure of manipulation. The silver market has long been suspected of being manipulated by large financial institutions through the paper market. If there were a major investigation or regulatory action that exposes and corrects this manipulation, it could lead to a rapid adjustment in silver prices to reflect its true market value. This could be a game changer, unleashing pent-up demand and driving prices sharply higher. Geopolitical shifts. Significant geopolitical events can act as catalysts for safe haven assets like silver. For instance, escalating tensions or conflicts in major regions can increase uncertainty, prompting investors to flock to precious metals. Similarly, any major economic policy shifts, such as changes in trade relations between the US and China, can impact silver prices. Increased geopolitical instability generally benefits precious metals as investors seek to protect their wealth. Changes in Federal Reserve policy. The Federal Reserve's monetary policy plays a crucial role in precious metal prices. If the Fed signals a shift towards lower interest rates or introduces more quantitative easing, it could weaken the US dollar and boost silver prices. Investors tend to move towards precious metals when the dollar depreciates, as these assets serve as a hedge against currency devaluation and inflation. Environmental and sustainability policies. Global policies aimed at sustainability and reducing carbon emissions can significantly boost silver demand. Silver is essential in various green technologies, and policies promoting clean energy can increase its industrial use. For instance, government incentives for solar energy projects and electric vehicle production can drive up silver demand and prices. Increased investment demand. Silver ETF and physical silver purchases by retail and institutional investors can also act as catalysts. Any significant increase in investment demand, driven by economic uncertainty or market trends, can push prices higher. For example, if there were a renewed silver squeeze movement similar to the one in 2021, it could lead to substantial price increases. Recognition of silver as a critical mineral. Efforts by industry leaders to have silver recognized as a critical mineral can also influence prices. If governments start to acknowledge silver's importance in technological and industrial applications, it could lead to supportive policies and increased investment. For instance, Canada's consideration of adding silver to its critical minerals list could accelerate development projects and attract more investment in the sector. In summary, these potential catalysts create a conducive environment for a significant surge in silver prices. As these factors align, they could collectively propel silver towards the $1,000 per ounce mark, making Rafi Farber's bold prediction a plausible scenario. Watching for these catalysts in the coming months will be key for investors looking to capitalize on this potential market shift.
Not at the central bank. You can redeem them for gold at Miles Franklin. The minute that no longer works, then that's it. It's dead. I mean, just because you technically can't do it at the Federal Reserve, they still have it on their balance sheet. Let's just assume. I haven't done any research. I'm just assuming that they have it. But I see a gold standard in a much more broader sense than just, can you go to the Fed and have them redeem it for you? Because that's that's generally what happens in like, let's say, 19th century sort of banking crises where they have a suspension of specie payments. Right, during a suspension of specie payments, where banks no longer provide you with gold and silver in return for your derivatives, for your receipts, for your dollars, or whatever it is, then it's not like they plummet to zero once there's a suspension of specie payments, and you can't say, oh, it's no longer backed by gold. Well, it's not backed by gold at that ratio. So if banks are suspending specie payments in the 19th century, what would you do? You would go to a coin shop or somebody who has gold and say, look, how many dollars do you want for this? The bank's going rate is whatever, $30 or $21, but they're closed right now because there's a bank holiday. So how many dollars will you take for an ounce? You'll say, well, what, 25, 26, whatever. So it's still there. It's just not being paid by the banks. This is just that same thing, but in a more centralized system. So once nobody trades any amount of dollars for any amount of gold, what happens is the gold retailers become banks. The banks become bankrupt. Everything flips on its head, and we start anew.
To conclude our analysis, let's consider how all these factors could come together to make the $1,000 silver price a reality by May 2024. This unprecedented surge is not just a speculative fantasy, but a scenario grounded in observable trends and market dynamics. The ongoing supply-demand imbalance is one of the most fundamental drivers. With mining production failing to meet the rapidly growing industrial and investment demands, the silver market is experiencing a significant deficit. This shortfall is exacerbated by the increasing use of silver in critical technologies like solar panels and electric vehicles, both of which are seeing explosive growth as the world shifts towards renewable energy. Geopolitical instability and economic uncertainties further enhance silver's appeal as a safe haven asset. In times of turmoil, investors flock to precious metals to protect their wealth, pushing prices higher. The persistent fears of inflation and potential monetary easing by the Federal Reserve could weaken the US dollar, making silver and other precious metals more attractive. The relationship between gold and silver also plays a crucial role. As gold prices climb towards new highs, silver is likely to follow due to their historical price correlation. Investors looking for alternatives to gold, especially as it becomes more expensive, often turn to silver, driving up its demand and price. Potential market catalysts, such as significant investments by influential figures like Elon Musk or breakthroughs in technology that increase silver's industrial use, could trigger rapid price movements. Additionally, if the manipulation in the paper market is exposed and corrected, it could lead to a dramatic revaluation of silver's market value. These factors, combined with the increasing recognition of silver's critical role in various industries, create a perfect storm for a potential price surge. As more investors become aware of these dynamics, the demand for silver could skyrocket, pushing prices to unprecedented levels. In conclusion, while the prediction of silver reaching $1,000 per ounce by May 2024 is bold, it is not unfounded. It is based on a thorough analysis of market trends, economic conditions, and potential catalysts. As we move closer to this timeframe, keeping an eye on these factors will be crucial. If they align as predicted, we could indeed witness one of the most significant price surges in the history of precious metals, validating Rafi Farber's audacious forecast. Stay tuned, and make sure to subscribe to our channel for more insights and updates on this fascinating market development. Remember, while these predictions are based on solid analysis, investing in precious metals should be done with caution and proper financial advice.
I don't think I've answered the question this way before, but I recall maybe I was 24, 25 when I read Atlas Shrugged first time. That was my first, not my first, but it was a big step towards me becoming libertarian. And I have problems with Ayn Rand, and I'm not a Randian or anything like that. I'm not the next Alan Greenspan, God forbid. But I remember there was this chapter in of John Galt's speech in Atlas Shrugged, where he like Ayn Rand likes to go into these like long winding like speeches of her characters where she like just like lets out her philosophy in this very pompous way, and it's annoying. But she starts it off with existence exists. Like, and I was reading, I was like, what? Okay, like, why are you starting with that? And then I read it and I was like, okay, it could be a lot shorter, but I get it. So like I would say to the Bitcoin people, like, existence exists. Bitcoin is a code. It's a series of data. It's ones and zeros, but it's a code to what? What's it a code to? Like people, like they say, oh, it has all the Tells the properties of money. Well, the code does. Yeah, you can divide it into Satoshi units. You can transfer it really easily. It's fungible. All the things that gold has that make it money, Bitcoin has it. And you know what? Bitcoin has it even better. Bitcoin has all the stuff that gold has that makes it a good money even better, except for the fact that it doesn't exist. That's the thing. And then people say to me, well, what do you mean it doesn't exist? Who are you to say what exists? I'm a physical being. I can see what exists and what doesn't exist. Like, if you can't accept the fact that existence exists, there's nothing really to explain. It's not. There's nothing there. It's you're chasing somebody else's fantasy, and that's all. So, like, what's a dollar? Why does a dollar exist? Because the dollar is the other side of the Fed's balance sheet, and the Fed has gold and debt, and the debt has value as long as it can be paid in the dollars that are still backed by the debt and the gold. It makes it a circle that goes in on itself, yeah, and eventually it will fly apart, yes, but for now it has value because the debt has value because it can be paid in dollars that are backed. But again, it goes in a circle. But Bitcoin doesn't exist, and nobody can convince me that it does. So if it doesn't exist, it's nothing.